Now, this is what the accuracy and defense should be earning for me. This is what I require. Are you following what I am saying? Now, please, don't get irritated. I am discussing again and again. Tell me, for a market risk, I want a premium of 13 minus 7. How much percentage? 6%. Enough, right or not? That is for a beta of what? 1. But for my 2 beta, I want 6% premium, more than 6, more than 6. I want how much premium? 12% premium. In plus what? 7. You see, I want 19% return for taking this particular risk. Enough, right or not? No. That means, for the aggressive share, for its risk, I want how much return? 19%. Response is or no? But you look at the part 1, 2 and say, what is the expected return of the aggressive share here? 16%. Tell me, it is expected to give only how much percent return? 16%. But I want how much return? 19%. Good share or bad share? Bad share. Buy or don't buy? Don't buy. Response is or no? No. Similarly, for the defensive share, I expect it to give how much percent return? 12%. But for its risk, I want only how much return? 10.42. For its risk, I want only 10.42. But it is expected to give me how much percent? 12%. It's a good buyer, bad buyer. Because it is expected to give me what? More than what I want from it for the given level of risk. Are you following what I am saying? So always, expected return is what I expect from it is more than what I want. What I expect is more than what I want. It is what? Good. What I expect is what? Less than what I want. It is bad. Very simple decision. Are you following what I am saying? This is what the person using a term called as alpha. Next one term called as what? Alpha. Nothing great. This expected return minus SML return. What is alpha? Expected return minus SML return. They are called as Jensen's alpha. What alpha? Jensen's alpha. Jensen's alpha. J-E-N-S-E-N. Jensen's alpha. Can I put it or not? No. See. Part 4. Jensen's alpha. En, if you substitute by what? A, name changes. Okay. Jensen's alpha. New term. Term na great, yeah. Nothing new conceptually. Okay. Jensen's alpha. Alpha is equal to expected return minus SML return. Alpha is equal to expected return minus SML return. Alpha is equal to expected return minus SML return. What expected return? What I believe it will give. What is required return? What I want. Can I proceed? No. Security, alpha, pricing. Aggressive share. Aggressive share. Tell me what is the expected return of aggressive share? 15. What SML return? 19. It is what? Minus 3. So 16 minus 19 minus 3. Negative alpha, good stocks are bad stock are bad stock. It is underpriced or overpriced or overpriced. The pricing is high. The pricing is high. Defensive stock. Tell me what minus what? I expect 12, but I want only 10.42. Expected minus SML. 12 minus 10.42 is how much? 1.58. Under or overpriced or underpriced? You are going to be underpriced. Now, to put it simple words, this defensive stock is giving 1.58% more premium than what I want. Now, for the given risk, I want a premium or not? Now, this defensive stock is giving the risk premium for what I want. It gives more risk premium than what I want. More risk premium. So it gives, because risk rate is going to always be what? Common. It gives higher risk premium for the given risk taker than what I require by the market portfolio. In this case, the risk premium is what? Negative. Minus 3% than what I want. Everybody follow what I am saying? In that case, it over satisfies me. In this case, what? It under satisfies me. I will not buy it. I will buy the share. Based on overpricing and underpricing is called as alpha. Enough for right or not? No. With this, we have completed this particular problem involving the two shares. Okay. Now, can I go to the next problem or not? Now, in this only new formula learned is what? Alpha. What is alpha? Expected return minus SML return. Expected means what I believe the share will be giving. SML means what? What I require. If what I expect, what I require is less than what they give, then we'll be saying what? It is a good stock and it's going to be a bad stock. Indicated by a positive alpha or negative alpha. Can I proceed or not? Now. Can I go to the next stage? Now. "17" will come back to that later. 18 has been completed. Yes. A small question number 19. Take question number 19, please. 1 minute sum, let us answer it quickly, okay? Vimal Enterprises, don't talk, please. Shh. Vimal Enterprises has a beta of 1.5, risk-free rate 7%, expected return on the market portfolio 14%, company presently pays a dividend of 2.5 per share, and investor expect a growth in dividend of 12% per annum in many years to come. Compute the required rate of return on the equity according to CAPM. What is the present market price of the equities assuming the computed return as the required return? Can we start or not? Now. First, we have to calculate what? Required return. What the other name for required return? SML return. Right on. First, step 1. Step 1, SML return or required return. SML return or required return. Tell me the formula. KE is equal to RF plus beta into RM minus RF. K is equal to RF plus beta into RM minus RF. Okay. Now, can I substitute the number or not? Everybody participate. What is risk-free return here? 7 plus. What is beta of the security? 1.5 into what is RM minus RF? What is the market portfolio? 14 minus 7. 7 plus 1.5 into 40 minus 7 is going to how much here? How much percentage here? 17.5 here. Equal to 17.5%. K is equal to 17.5%. K is equal to 17.5%. Suppose market is perfectly pricing. This should be my expected return also. Right or not? Right now. Next. Step 2. Calculation of the share value. Calculation of the share value. Okay. Tell me, when I buy the share today, what is it I'll get from the share? I'll get D1 to D infinity. I will be getting what? D1 to D infinity. And this expectation is of a constant dividend, growing dividend, growing dividend. At what rate I believe the dividend is going to grow? 12%. In that case, the present value of a 12% growing dividend will be the value of the share today. Respond, yes or no? Tell me, what is the present value of a growing perpetuity? Normal formula, cash flow 1 by R minus G. Here the cash flow 1 is what? First dividend. R is what? KE, discounted minus growth rate. Nothing but the present value of a growing perpetuity. Respond, yes or no? So now in that case, they given you dividend or not? 2.5 rupees is D1, not D0. Why is it is D0? Presently pays. Means what? Present tense. The D1 should be what? Future tense. So it is going to be D0. Now D1 will be same 2.5 or more or more. How much percent more? 12% more. Respond, yes or no? Write down. Next. D1 is equal to formula. D1 is equal to what? D0 into 1 plus G. D1 is equal to D0 into 1 plus G. What is D0? 2.5 into 1.12 into 1. Please. 2.8, 2.80. D1 is equal to 2.80. P0 is equal to what? D1 by KE minus G. D1 by KE minus G. Please. What is D1? 2.80 divided by what is KE? 17.5% minus what is growth rate here? 12%. 2.8 divided by 17.5% minus 12%. Simply 2.8 by 5.5%. What's the number? 1%? 50? 50.90. 50.9. The share should be trading at how much base? 50.9. It is 50.9. Respond, yes or no? Tell me. If I buy the share at 50.9 rupees, answer my question. If I pay 50.9 and buy this share and get D1 to D infinity at 12% interest rate where D0 is 2.5, what is the IRR of my investment? IRR of my investment is how much percent? 17.5%. And what I want is also what? 17.5%. I'll be happy. Yes or no? Suppose I pay more than 50.9. Suppose 60 rupees or 70 rupees to buy the share. Will the IRR be 17.5 or less than 17.5 or less than 17.5? What I want is what? 70. What I expect is what? Less than 17.5. I'll reject that share. Everybody, are you following what I'm saying? Is the answer for this particular sum? Question number 19. So we just discussed the first level in CAPM, standard CAPM problems. Are you able to understand or not? In all these problems, ultimately, very simply, nothing really learned. Only two things I learned. One is how to calculate beta. How to calculate what? Beta. Number two, how to find out underpricing or overpricing. In all the problems, only two issues are discussed. One is what? Beta calculation. Second is what? Underpricing or overpricing. If you are comfortable with this, this is completed. Everybody following or not? Can I proceed further? Now, next. In this CAPM, capital asset pricing model, I have to discuss two more topics. Discuss what? Two more topics. This I call as a level 1 discussion. Can I proceed? Now, the two more topics to be discussed is portfolio beta. Next item is what? Portfolio beta. Third topic is levered beta, and then what? Unlevered beta. It leads to a proxy beta discussion also. Okay. So two topics to be discussed. One is what? Portfolio beta. Second is what? Levered, unlevered beta as well as proxy beta. Once I complete these two, but I completed CAPM fully. Everybody, are you understanding or not? Now, in this, I'm going to go for the next issue called as what? Portfolio beta. Nothing great, very, very simple issue. We'll discuss that and then you can just go for the problems in this regard. Again, very repeatedly asked examination area. Can I proceed? Now. Stop talking, please. Can I proceed? Waiting. I'm not saying any Vijay dialogue, yeah, but I'm really waiting for you. Can I proceed now? AC switch on or switch off? Yes, sir. Please. I have obeyed you. I asked you to switch off the AC. Now can you obey me or not? Give and take. Can I say now? I want silence here, please. Listen. As I said, if you want to invest in a financial asset, it's very simple. I only know two things about the asset. One is what? Return. Other is what? Risk. Any other asset, you see the quality, you see the performance, so many things are there in normal assets. When you buy a financial asset, we need not look at so many things. Two items you have to see. One is return, other is what? Risk. Okay. Earlier, we measure the risk as standard deviation. Now, after CAPM, we started measuring risk as what? Beta. Standard deviation is an absolute measure. Beta is what? Relative measure. Right or not? No. So now, risk can be measured either through sigma, that is standard deviation, or through what? Beta. Now, see. There is a single security. It can have a sigma or not? Yes. A single share can have a standard deviation. A single share can have a beta. MTH share can have a standard deviation. Its share return can also have what? Beta. How a single share can have a standard deviation as well as what? Beta. If I construct a portfolio of shares, if I construct what? Portfolio of shares, there is going to be a portfolio of standard deviation. Like that, there is going to be a portfolio of beta also. Right or not? How there can be a sigma for a portfolio, there can be a beta for a portfolio also. Right or not? Very simple, yeah. Investment in SFL share alone is what? A single investment. SFL is having a sigma, yes. That's what? A beta. Yes or no? Like that, I don't invest in SFL share alone. I invest in what? SFL share and other two companies. I make the portfolio investment. The portfolio is having a standard deviation or not? Yes. We got a sigma P. We got a standard deviation of the portfolio. That portfolio can move with the market portfolio. This portfolio is having another portfolio as well. Market portfolio. These two can be linked or not? Yes. It is called as portfolio beta. Right or not? Now, for example, let us take a two security. What is standard deviation of a portfolio? I want a formula. What's standard deviation of portfolio? Everybody yes or tell me, yeah. Everybody tell me what it does, yeah. W1 square sigma x square plus 1 W2 square sigma y square plus 2 into W1 into W2 into sigma x into sigma y in correlation of x and y. Yes or no? No. Let us take what? Square root. That gives standard deviation of the portfolio. Respond yes or no? No. Like that. Portfolio should have a beta or not? No. Beta of a portfolio is very simple. It is W1 beta x plus W2 beta y. That's all. Yes or no? That is, beta of a portfolio is simply the weighted average beta of the individual securities. What is beta of a portfolio? Weighted average beta of the individual securities. But when I discuss standard deviation of a portfolio, I said portfolio standard deviation is not equal to what? Weighted average standard deviation. Because the three factors influences the risk, namely the risk of individual security, proportion, and then co-movement. We have correlation in this discussion. Respond yes or no? Now, the question is, so both are risk. Both are what? Risk. For standard deviation of portfolio alone, you have taken what? Co-movements in the calculation, because individual security risk is what? Sigma x. Proportion, that is, security risk is sigma x and sigma y. Proportion is what? W1 and W2. And the co-movement is measured through what? Correlation. All the three factors are taken into account. Yes or no? Now, when I come to the beta alone, this is also risk. This is also what? Risk. I have the proportion of individual security. And the individual security risk called as what? Beta x, beta y. Where the co-movement has gone? Question arises now. Question pudinjudha? Now, be a little bit serious, please. Why you have been talking? Now, otherwise I'll stop the class here. This is not the right way to listen to the class, right? When I am speaking, you have no business to speak here. Understand, you have paid to listen, right? I have been paid to speak. Both having what? Two different roles. Appreciate the role, correct? Once a side comment, it can be appreciated. Side comment, class should not run. That is, we are not going out of track. And now, when I was speaking, I heard some voices again speaking along with me. This is not right. There are so many students who want to listen here. This is going to create disturbance in the class, right? Then what I am discussing, tell me. Don't say portfolio bit, that heading I am saying, okay, now I am discussing one point or not. See. No, you don't open your mouth, I will open. You just open your ears and listen. Can I say, please? Shh. Now, the question is, portfolio standard deviation is not equal to weighted average standard deviation of individual security. Right or not? It can be weighted average only when the correlation is 1. What I am saying? Otherwise, portfolio standard deviation is not equal to what? Weighted average standard deviation of the individual securities. That you are all following or not? Why question arises? We said the standard deviation or the risk depends on the risk of the individual security, sigma x, sigma y. The portfolio risk depends on the proportion investing W1, W2. It not only depends on the individual security risk, it not only depends on what? Proportion investing, it also depends on what? Co-movements. Where diversification reduces what? Risk. It also depends on what? Co-movement, which is going to be represented by what? Correlation of X and Y. So 3 factors affects the risk we discussed, and the formula properly reflects all the 3. Right or not? Now, same thing, instead of standard, I use what? Beta. When I wrote the beta of a portfolio, I did not write such a big formula. I simply said what? Weighted average beta of the individual security. Right or not? The doubt is, sir, risk is influenced by the risk of individual security. Right or not? I have beta X, beta Y. Now beta represents risk. Right or not? And it also influenced by what? Portfolio proportion, W1 and then W2. Now you may ask, sir, where is the third term? That is co-movement. What is the third term? What? Co-movement. Where correlation is? Question arises now. Where is correlation? Inside the beta. It is going to be there inside the what? Beta. Very simply, I need not know about correlation of X and Y. I won't know only about correlation of what? X and market, Y and market. What I am saying? Because if market influences X, market influences what? Y, I have taken correlation of X and market, Y and market. Apart from that, if there is any other correlation between what? X and Y, it is not systematic, it is unsystematic. For that and all, I will not be giving return for the portfolio. ரொம்ப simple, yeah. X and Y a correlate. There is a market portfolio. It can be what? Market portfolio. There can be 3 correlation. X and market, Y and market, X and Y. In that case, X and market, Y and market, if I link, one thing is sure, X and Y to the extent of systematic risk is linked. If there is still any unleft correlation, the correlation only due to what? Unsystematic risk. For that risk and all, portfolio cannot be given what? Risk premium. Please tell me, understand what I am saying? That is why I need not correlate X and Y. I have already correlated what? X and market using what? Beta. What is beta X? Sigma S by sigma M into correlation of S and M. So correlation of X with the market founded or not? Yes. Like that, this beta Y is having correlation of Y with what? Market. X with market I have correlated. Y with market I have what? Correlated. In that case, X and Y correlation also what? Automatically established to the extent of systematic risk. Any other correlation happens between X and Y apart from this is due to what? Specific factors between X and Y and not due to what? Market factor. That you can diversify by investing in Z, A, B, etc. Are you following what I am saying? For that they are not going to give you the risk premium. Now, so beta has become very simple. What beta of a portfolio? Weighted average beta of the individual securities. That is why the Markov weights is made much more simpler here. Suppose you use Markowitz here, there's a 100 security portfolio. How much security portfolio? 100 security portfolio. To calculate the risk, you have to calculate 10,000 terms here. Now n square, how many terms here? 10,000 terms. Forming only how many terms here? 100 terms. W1 beta 1 plus W2 beta 2 plus W3 beta 3 plus what? W100 beta 100 matter over. Are you following what I am saying? It has made the entire stock market analysis very simple. Other main advantage of CAPM itself. S1. Are you following not? They made some assumptions. All those assumptions made our work very simpler and what? Easier. A 10,000 term risk has been made into what? A 100 term risk calculation. Everybody, are you following what I am saying? So this is regarding the beta of a portfolio. Can I proceed further or not? No. We can start doing the problems in this portfolio beta. Nothing more. It's a one-line sentence. ரொம்ப simple. Is a security having a risk or not? Risk of a security can be measured in two ways. No, two ways. Sigma. So sigma, beta. Sigma of security is square root of sigma x minus x power the whole square divided by n. Beta of security is what? Sigma s by sigma m into correlation of s and m. That is already known. Okay, now how a security can have a sigma and beta? A portfolio security also can have what? Sigma and beta. The portfolio sigma is equal to what? W1 square, sigma x square, etc. etc. And the portfolio beta is simply what? Weighted average beta of the individual securities. Why we don't have a co-movement? Yes, we have the co-movement. That inside what? Correlation itself. Is the co-movement between what? Security and the market. Between two securities, I am not worried about the co-movement because I want to only have a premium for the systematic risk. I don't want to have a premium for what? Unsystematic risk. Is the answer for that. Innapa right or not? Now, write down. Give the heading portfolio beta. Give the heading portfolio beta. Write down. Beta of a portfolio. Sorry. Portfolio beta. Just have elaborate notes. Point number 1. How individual securities can have sigma and beta. How individual securities can have sigma and beta. Portfolio 2 can have sigma and beta. Portfolio 2 can have sigma and beta. Portfolio 2 can have sigma and beta. Can you proceed or not? Next, point number 1 or 2? 2. Sigma P is equal to standardization of portfolio is equal to W1 square sigma x square plus W1 square sigma x square plus W2 square sigma y square plus 2W1 W2 sigma x sigma y correlation of x and y plus 2W1 W2 sigma x sigma y correlation of x and y square root. However, beta of portfolio is simply what? Weighted average beta of individual securities. However, beta of portfolio is simply weighted average beta of individual securities. Beta of portfolio is simply weighted average beta of individual securities. That is, beta P is equal to W1 beta x plus W1 beta x plus W2 beta y. W1 beta x plus W2 beta y. Over into, can I proceed or not? W1 beta x plus W2 beta y. Can I proceed now? Next. Write down point number 2 or 3? 3. Point number 3. We saw that portfolio risk is influenced by Portfolio risk is influenced by three factors. Portfolio risk influenced by three factors. Branch it into three. You are writing it once again. Branch it into three. What is the first factor here? Individual security risk. Individual security risk. Second branch is what? Proportion. Third is co-movement. Proportion. And then what? Co-movement. Individual security risk, put it on like a right, measured by sigma or beta. And either measure the risk as standard deviation or by what? Beta. Both ways you are doing it not. Measured by sigma or beta. Measured by sigma or beta. Now, proportion is what? W1 and W2. Proportion is W1 and W2. Co-movement, correlation, coefficient. Third branch, co-movement is what? Correlation, coefficient. Correlation, coefficient. Last point. Point number 3 or 4 or 5? Point number 4. In portfolio beta formula, there is no correlation of X and Y. In portfolio beta formula, there is no correlation of X and Y. There is no correlation of X and Y. Is co-movement ignored? There is no correlation of X and Y. Is co-movement ignored? There is no correlation of X and Y. Is co-movement ignored? Question mark. Is co-movement ignored? Tell me, is it ignored or not ignored? Right answer, no. Because beta has the correlation between each security and market. No, because beta has correlation between each security and market. And if that exists, any more correlation between the X and Y, if there exists any more correlation between X and Y, it is purely, if there exists any more correlation between X and Y, it is purely systematic, unsystematic, unsystematic. It is purely unsystematic, for which we do not require. It is purely unsystematic. For this we do not require premium. For this we do not require premium. For this we do not require premium. Now, very simple here. Again listen what I try to say here. X moves with market, Y moves with market. I call it X and market, Y and market or not. So then X and Y is automatically correlated. Is the first argument. Yes or no? X moves with market so many times, Y moves with market what? So many times. Then X moves with what? Y so many times is automatically correlated. Point number 1. Yes or no? You will still say, no sir, you are wrong. The correlation between X and Y is what? Something different than what you establish with that what? A triangular market correlation. I say, it may be that it is not due to market, it is due to what? Some other reason. That is what? Unsystematic portion. I don't want that particular number. Everybody following what I am saying? That is why we just ignore the correlation between X and Y in our calculation. Ennappa right or not? Now, with this we complete the portfolio beta introduction. Can I go for the problems or not? Now. Take the next question, question number 10. All these problems are very simple, easy sums, but very important. Take question number 20. You are considering, please. Now it is, what time? 8:20 now. We should complete up to question number 23 minimum, or if possible 24. Okay, can you start or not? Now, please do fast, participate. You are analyzing a portfolio consisting of 4 securities. Data are A, B, C, D. Beta of the security is 1.40, 0.7, 1.1. Expected return of each and every security. Tell me what is the meaning of this expected return? Average return. What average? Simple or weighted average, as the case may be. Amount invested by you is also given. This amount invested is book value of investment, current market value, current market value. Always when I say invested so much, I bought a share 10 years ago at 10 rupees here. Today trading at what? 80 rupees. Now my investment is 10 rupees, 80 rupees, 80 rupees. On that only you should be asking a yield. Yes or no? So always the word invested means what? Market value of investment. One should be understanding it. Can I proceed? Now. Calculate portfolio return and beta and analyze the individual securities. One data is missing, write down. Assume. One data is missing, right? Assume. Expected return on market portfolio. Assume expected return on market portfolio to be 10%. Assume expected return on market portfolio to be 10%. Assume expected return on market portfolio to be 10%. Tell me in simple word, what is 10%? RM. RM is what? 10%. Now, to do any CAPM problem, I require RM and then RF. Now, RM not given, I omitted to type it, I give it how much percentage? 10%. Okay. Now, what is RF? Given or not given? So what is risk-free rate? What is RF? Given or not given? Because the security B is having beta of what? 0. Security having no beta is assumed to be what? Risk-free, and the RF is how much percentage? 6%. Yes or no? If beta is 0, the risk premium is what? 0. Then the entire return should be what return? Risk-free return. So we can assume the RF to be what? 6% because it is having a beta of 0. Accepted or not? Now. So in this problem, before I proceed to the solution, tell me what is RM? 10%. The 10% return from security A, B, C, D, A, B, C, D. Again ask the question, listen here. 10% I gave the return market portfolio, how much percent? 10%. 10% is the expected return of A, or B, or C, or D, or the portfolio A, B, C, D. All the 4, no. It is a market portfolio. It is A, B, C, D, E, F, G, H, I, J, up to what? Z. All shares are there or not? It is a return of what? Market portfolio. My portfolio different, market portfolio different. Everybody, I will follow what I am saying. The 10% is return what? Market portfolio. If I invest in B, what return here? 6%. I call it as what return here? Risk-free return. Are all the details given. Can we start or not? No. Let's start doing the problem number 1. First, what is portfolio return? Model question, what is portfolio return? Return of a portfolio is equal to, answer is equal to what? Weighted average return of the individual securities in the portfolio, etc. Not? No. What is a portfolio beta? What is that? Beta of a portfolio is also equal to what? Weighted average beta of the individual securities. So can we start doing the portfolio return, portfolio beta or not? Yes, write down step 1. Let's do it together. Write down step 1. Calculation of step 1, calculation of portfolio return. Calculation of portfolio return. Okay. Can we start or not? Now, the columns are securities. First column, security. Second column, value. We also call as investment. Security, value. The third column is proportion. You can tell me the proportion, 3 decimals. Generally, you should round it off in 3 decimals sometimes. Okay, proportion. Next is what? Return. Last column is weighted return. Can I start or not? Now, tell me what are the 4 securities inside portfolio? A, B, C, and then D. Securities are A, B, C, and then D. Shall I proceed? Now, what is the value of A, B, C, D? What is the amount invested here? 3.8 million. Next is 5.2 million, 6.1 million, 2.9 million. Can tell me the total investment? How many days? 18. The investment total is 18 million. Please tell me the proportion in 3 decimals. Okay. 3.8 divided by 18. How much is 0.211. 0.211. 5.2 by 18. What is the number? 0.289. 0.289. Now, without confusion, don't please drag on the calculations. Tell me clearly, I should hear it. Okay. 6.1 by 18. What's the number? Point? Okay, 0.339. 2.9 by 18. 0.161. 0.161. Obviously, the total should be what? 1. Every security expected to give a return or not? Now, this expected return is sure, unsure, unsure. Always average is unsure. It is an average. Not expected return. Tell me it is how much here? 16. Sorry, 16, 6, 10 and then 13. 10 and then 13. 16, 6, 10 and then 13. Multiply and tell me. Now tell me in 2 decimals in our 0.211 into 16 is how much percentage? 1%? 3.38%. Next. 1.73. 3.39. Last. 2.09. If I total, what is the total? 10.59. What is 10.59? RP, return of the portfolio. This portfolio is expected to give a return of how much percent? 10.59. To put it simply, if I invest the full money in A, I earn how much? 16. Full money in B, 6 and so on. In this proportion when I invested, the expected return is how much here? 10.59. Here the expected return of the portfolio. This is what I believe that the portfolio is likely to give me. Respond. Are you all following what I am saying? Now, next. This return is 100% sure or unsure? This portfolio return is having what? Risk. I can measure the risk in 2 ways, either by what? Sigma or through what? Beta. I am using marker which now a CAPM or CAPM. They ask you to calculate what? Beta of the portfolio. Now, what is the beta of the portfolio? Weighted average beta of the individual securities gives the portfolio beta. Everything calculation same. Instead of when I put what? Beta and then calculate it. Can I proceed or not? Write down. Next. Step 1 or step 2? Step 2. Write down step 2. Portfolio beta. Beta of portfolio. Step 2 is portfolio beta. Same columns. What are the columns? Security, value, proportion, beta, and then weighted beta. Security, value, proportion, beta, and then weighted beta. Can name the securities A, B, C, D. Value 3.8 million, 5.2 million, 6.1 million, 2.9 million. Totals to 18. Now only you calculate proportion na 0.211, 0.211, 0.289. 0.339, 0.161. The total is 1. The beta of the respective securities are 1.4 times. It represents risk na 1.4 times. Risk free 0, 0.7, 1.1. Tell me beta in 2 decimals. Okay. 1.4 into 0.211, 0.29. This I will do 0. Next. 0.24. Okay, 0.18. What the portfolio beta? Point. So this color is what? Please don't. What the urupada beta P is equal to what? 0.71. Okay. Beta portfolio is equal to what? 0.71. Respond yes or no now. Tell me, my portfolio is riskier than market or less riskier than market or less riskier than market beta? My portfolio beta is what? Less than market beta portfolio 1. My response is or no? No. Next is, for this portfolio, I expect a return how much? 10.59. But is this 10.59 sufficient or insufficient? Stop. Listen here. Always the chapter seems to be understood, but we always get what? Vague about the discussion. That is why I'm going to again what? Revisit. Now, listen here. I have a portfolio of A, B, C, D in this proportion. Suppose there's a portfolio A, B, C, D in this proportion. Now, this portfolio is having a risk of how much? 0.71 beta. Now, it is giving a return how much? 10.59. My question is 10.59 correct return for a 0.71 risk? We have to check it. We have to want to check it by calculating SML return. Yes or no? I should calculate the equilibrium return and then compare with what? 10 points. Is the expected return. That is what the required return. Yes or no? If this is more, the portfolio is what? Good. Less means what? The portfolio is bad. Right or not? Now, can I proceed further? Next, write down. Step 2 or step 3? Step 3, please. Write down. Step 3. SML return of portfolio. SML return of portfolio. SML return of portfolio. Everybody, can we start or not? Now, write on. KE is equal to formula RF plus beta into RM minus RF. RF plus beta into RM minus RF. Now, tell me what is risk-free return here? 6%. And B is said to be risk-free 6% plus. What is beta? 0.71. The profit is how much? 0.71 into what is RM? I dictated in the question. What is RM here? 10 minus 6. 8.84 percentage. So 8.84 percentage. Very simple. For this portfolio's risk, I should expect only how much? 8.84. I should require 8.84. But it is expected to give how much? 10.59. This is a positive alpha portfolio. Negative alpha, positive alpha. The portfolio overall is overpriced, underpriced, underpriced. Somebody wants to sell this package portfolio. I'll buy it or not? Yes. I'd rather buy it because the expected return is what? More than the required return. Everybody, yes or no? Write down conclusion. Write down conclusion. Conclusion. For this portfolio's risk, we should require a return of. For this portfolio's risk, we should require a return of. Tell me how much percentage? 8.84 percentage. We should require return of 8.84 percentage. But the portfolio is expected to give. 10.59 percentage. But the portfolio is expected to give 10.59 percentage. The portfolio is expected to give 10.59 percentage. Hence, the portfolio is, tell me, fill in the blank, portfolio is perfectly priced, overpriced, underpriced. The portfolio is underpriced. The portfolio is underpriced. The portfolio is underpriced. Recommended to buy the portfolio. Recommended to buy the portfolio. Recommended to buy the portfolio. Everybody, are you comfortable or not? Now, next is. Now, we have analyzed the portfolio on a whole, yes or no? We can even analyze the individual securities inside the portfolio or not. Is A overpriced or underpriced? B overpriced, underpriced? How portfolio can be underpriced and overpriced? The security inside that also can be one underpriced and overpriced, which gives me more input for my decision making. Ennappa, right or not? In that case, now I have to find out underpricing and overpricing of what? A, B, C, D. Why I am doing it? Question says analyze the individual securities. We analyze it or not? Now, can I proceed further? Write down next last step. Step 2 or step 3 or step 4? Write down step 4. Step 4, analysis of individual securities. Step 4, analysis of individual securities. Okay. Okay. How you will tell a security is good or bad? By comparing his expected return and the required return. This is always same story again and again. How when a security is a good or bad security? Comparing the expected return with what? Required return. Expected return for A, B, C, D given or not? Yes. The average return given. Required return is found using what formula? RF plus beta into RM minus RF. And then compare and make the decision. Ennappa, right or not? Now, can you go for the calculation? Have the following column. First column, security. First column, security. Second column, SML return. Second column, SML return. Leave a broad space to do the calculation. The formula is what? RF plus beta into RM minus RF. The second column called as what return? SML return. Now, what is the third column? Expected return. Leave sufficient space for the SML return. Third column is what? Expected return. Fourth column is what? Status. Status na underpriced or overpriced. Fourth column is status. Okay, one by one. Let's start with security A. Security A. Okay. RF plus. Everybody do along with me. What is RF? 6 plus. 6 plus. What is beta of security A? Everybody how many days here? 1.4 into what minus what? 10 minus 6. 6 plus 1.4 into 10 minus 6. Am I right or not? Tell me what is the number here? You know what is that? 11.6. Right, security B. Security B. What is RF? 6 plus. Beta is what? 0 into 10 minus 6. Is equal to what? 6. Is equal to 6. Security C. RF plus 6 plus. What is beta? 0.7 into 10 minus 6. What's the number here? 8.8. Security D. RF plus 6 plus 1.1 into 10 minus 6. How many days here? 10.4. This is what the security should be giving me. Ennappa, right or not? No. But what it is expected to give me so much here? 16. Next is what? 6, 10, and then 13. In the expected return, that is expected to give or which is likely to give. Can I proceed? Now tell me. I want 11.6. Let's expect to give what? 16. Good or bad? Good. One underpriced or overpriced? Underpriced. Status what? Underpriced. Status right? Underpriced. First security is underpriced. Now, I want how much? 6. Expect to give what? 6. It is what? Perfectly priced. It is perfectly priced. I want 8.8. Let's expect to give what? 10. What is it here? Underpriced. I want 10.4. Expect to give what? 13. Once again is what? Underpriced. So this is how we analyze security as what? Underpriced or overpriced. Overall the portfolio also is what? Underpriced. So I can buy individual securities as well as what? Portfolio as a whole. Everything is good. Are you following or not? With this we complete this particular problem. If you want, you can also calculate alpha. Now tell me what is alpha formula? Expected return minus what? SML return. High alpha stock should be purchased because even the underpricing is there. How much difference is what? That bigger the alpha, more the underpricing. Jump and buy the security. Respond. Are you following what I am saying? So this is regarding question number 20. Ennappa purinjudha illaya? I'll go for the next term. Take question number 21. Take question number 21. An examination problem, a compulsory question asked for 5 marks. Okay. Now, you have 5 lakhs to invest, please, in a stock portfolio. Your choices are stock A, where you invest 1 lakh 40, stock B, where you invest 1 lakh 60, and stock C and risk-free asset, where you invest the balance. Given the beta of stock A 0.9, stock B 1.2 and stock C 1.6, and overall beta is that of the whole market, how much money will you invest in stock C and risk-free asset is a question. It is a past examination problem. First question you should know that we are having 4 parts of 5 marks each or not. Is one of the 5 marks question has been asked in the examination. Okay. Read the question and then let us start with the solution. Please go through the question quickly. Shall we start on? Now, first of all, I am going to invest in one security or portfolio of securities. Name the security which is going to be inside my portfolio. A, B, C under risk-free security. These individual securities having a risk or not? Yes. What is the beta of A? 0.9. What is the beta of B? Beta of C? What is the beta of the risk-free asset? 0. R of beta should be always what? 0. Is the beta of the individual security. Yes or no? Now, if I combine all this, I have a portfolio or not? Now, I fix a target. I want my portfolio to have a beta or not. What is the beta I want to have for my portfolio? Tell me. Because sometimes people may target risk and construct a portfolio. So no. Now I have targeted a risk that my portfolio beta should be what? Tell me the target portfolio beta. Now, stop sleeping, wake up. Question now, I am going to invest in a portfolio consists of what? A, B, C, D. A, B, C and what? Risk-free asset. Please. Now, this portfolio will have a beta or not? A, B, C is having a beta. R of beta is what? 0. I make a combination into a portfolio. The portfolio have a beta or not? I want my portfolio to have what beta? Beta as 1. I want my portfolio to have what? Beta as 1. How we know I want 1 as a target beta? Because they said, and the overall beta is that of what? Whole market. What is the beta of a market portfolio? 1. I move with myself one time. What is beta of market portfolio? 1. I want my portfolio beta to have the same beta as what? Market. So I should be having as what? 1 the beta. Enough or not? Now. So now the question is, I already decide how much to invest. How much invest? 5 lakhs. I already decide how much invest in what? A and B. How much invest in A and B? 1 lakh 40 and 1 lakh 60. The question is, how much should I invest in C? How much should I invest in what? R. So the beta of the portfolio becomes what? 1. This is the question. Always, once you understand the question, answer is very simple. Child's play. Are you following what I am saying? So main thing is only understanding what? Question. Now tell me, how much money I have to invest? 5 lakhs. When I invest in this 5 lakhs, I already decided to invest in A and B how much? 1 lakh 40, 1 lakh 60. I should invest the balance in what? C and RF. In what proportion? In such a proportion that gives me the portfolio beta as what? 1. Is the question, the proportion asked you to find out in C and RF. Ennappa, can we start or not? Let's start doing the solution together. Write down first. Write down security, please. Security, value, proportion. Security, value, and then proportion. Can we start down? Now, A, B, C and RF. I don't know the breakup yet, okay? I'll just do it later. So I just have C and RF. A, B, and then C and RF. Okay. C and risk-free asset. How much I invest in A? 1,40,000. What is that in B? 1,60,000. What is in C and RF? Balancing. It is 2 lakhs. The total is 5 lakhs. I invest in A 1,40,000, B 1,60,000, C and RF 2 lakhs. The total is 5 lakhs. What the proportion of A to the total here? 0.28. The A in the portfolio is 0.28 weight. What is the weight of B? 0.32. Weight of B is 0.32. What is the weight of C and RF? 0.4 is C, RF for C and RF for C and RF. Response is or no? And the total is 1. The total portfolio proportion to be 1. Everybody, can I proceed? Are you all doing along with me or not? Write down next. Let proportion of A, B, C and RF be. Let proportion of A, B, C and RF be weight of A, weight of B, weight of C, and then weight of RF. Weight of A, weight of B, weight of C, and then what? Weight of RF. Can I proceed or not? Now, see. Beta of portfolio is equal to weight or beta of Windows securities or not? Beta of portfolio is equal to weight of A, beta of A, proportion of A, beta of A, understanding the formula or not? Plus weight of B, beta of B, plus weight of B, beta of B, plus what? Weight of C, beta of C, plus weight of C, beta of C. Last term plus weight of R of beta, I have written Y. Beta R of is what? 0. So it is going to be what? 0. It is only the weighted beta of the risky securities. Riskers will not have a beta at all. Response is or no. So this is a formula. Enough right or not? Now. I want my portfolio beta to be what? 1. Write down. 1 is equal to. I want the beta portfolio is 1 or not? 1 is equal to. My target beta is 1. Is or no? 1 is equal to. What is weight of A? Look at the problem. 0.28 into 0.9. 0.28 into 0.9. Tell me what is 0.9? What is 0.9? Beta of A. What is 0.28? Proportion of A. Plus 0.32 into 1.2. 0.32 is proportion of B. 1.2 is what? Beta of B. 0.32 into 1.2. Plus what? Weight of C, I don't know. I have to find out now. Weight of C into what? 1.6. What is 1.6? Beta of C. Plus weight of C into 1.6. 0.28 into 9 plus 0.32 into 1.2 plus weight of C into 1.6. If I rearrange, can't I find out weight of C or not? Yes. Weight of C is equal to 0.2275. And believe my numbers, it can be calculated. Weight of C is equal to what? 0.2275. Weight of C is 0.2275. Yes or no? Now, C and risk-free together, the weight is 0.4. 40% of the money I'm going to put in what? C and risk-free. In this 0.2275, go for what? C. What the balance here? Risk-free. Right? And RF is equal to, weight of RF is equal to, all of you participate. Weight of RF is equal to what? 0.4 minus 0.2275. Weight of RF is equal to 0.4 minus 0.227 is equal to how much? 0.1725. Weight of RF is equal to 0.1725. Is equal to 0.1725. I want you to respond. Everybody, yes or no? Now tell me, if I have 5 lakh rupees, I'll invest how much in A? 1 lakh 40. How much in B? 1 lakh 60. How much in C? 0.2275 into what? 5 lakhs. Will be invested in what? C. What is in D? 0.1725 into 5 lakhs. Everybody yes or no? No. Let's check our answer. Let's write check. Write down check. Security, proportion, value, beta, weighted beta. Security, proportion, value, beta and weighted beta. Security, proportion, value, beta and weighted beta. Writing on with me or not? Tell me what are securities? A, B, C, RF. A, B, C and then RF. What is proportion of A, B, C and RF? Tell me the proportion here. That is 0.28. All of it is 0.28. Next is what? 0.32. Third, 0.2275. 0.1725. The total is 1. The total is 1. What is value of A? 1 lakh 40. Out of 5 lakhs, 1 lakh 40. B is how much? 1 lakh 60. Calculator 5 lakhs into 0.2275. What's the number? 1 lakh 13,750. 113,750. And RF is what? 0.1725. 5 lakh is how much here? 86,250. The value is 5 lakhs. The value is 5 lakhs. Can I proceed on? Now, tell me the beta of all these 4 stocks here. What is beta of A? 0.9. Beta B is how much? 1.2. Beta C is 1.6. RF is 0. 0.9, 1.2, 1.6 and then 0. Tell me what is the weighted beta? 0.28 into 0.9 gives you how much? 0.252. 0.252. 0.32 into 1.2 gives you 0.384. 0.32 into 1.2, 0.384. 0.2275 into 1.6 gives how much? 0.364. Next is what? 0. What is the portfolio beta? 1. This proportion gives a target portfolio beta of 1. Other question is audible. Respond. Are you following on? So with this we complete solution to question number 21. Everybody, are you having the clarity or not? Okay, take question number 22. Take question number 22. Last sum. Take question number 22, please. A stock has, don't talk, please. A stock has beta of 1.6 and a expected return of 16%. Risk-free asset is currently earning 5%. 1 minute, yeah. Just for convenience, those who want to leave immediately, please leave, or leave after the problem. Choice I give you, please. Not angry, yeah? I am saying for both convenience, okay. But can I proceed? Now, once I start doing, you should not put pressure on me to complete. I should complete what? Leisurely. Can I proceed? Now. Stock has a beta of 1.6, expected return of 16%. What is the expected return of? That is, the currently risk-free asset is going to be 5%. What is the expected return of a portfolio of 2 assets invested in equal proportion? We will do part by part. Instead of reading every part together, we will be starting with the part D. Can we start or not? No. First write down facts. All these sums are very simple problem. This is also an examination sum. Write down facts. Write down. Beta of security is equal to beta, yes, you can call beta of security is equal to how many times? 1.6. 1.6. Beta of security is equal to 1.6. RS. RS means what? Return of security. RS, return of security is equal to how much? 16%. Return of security is equal to 16%. RS 16%. RF, what is risk-free return? 5%. RF is equal to 5%. RF is equal to 5%. Beta RF is equal to what? 0. Beta RF is equal to 0. With these four numbers only, the entire problem is going to be done. So, what is the security return? 16%. What is the beta? 1.6. Risk return? 5%. The beta is 0. That's all. Can you understand or not? Now, first, part A. Now, I am going to construct a portfolio of what? These two assets. What are two assets here? Risky, risk-free. In what proportion? Equal proportion. This portfolio should be having a return as well as what? Risk. Yes or no? You have to find it or not? Can you start? Write down. Next. Part A. Portfolio return when? Part A. Portfolio return when amount invested equally in two assets. I just answering question one by one. Portfolio return when amount invested equally in two assets. When amount invested equally in two assets. Okay. Return of a portfolio is what? Weighted average return. Right or not? Now tell me the columns here. Asset, proportion, return, weighted return. Asset, proportion, return, and then weighted return. Tell me what are the two assets? Security, risk-free. Security and then risk-free. In what proportion? Equal. Question said now 0.5, 0.5. Proportion is equal 0.5, 0.5. What is the RS return of security? 16. RF is 5. What is weighted return? 8 and then 2.5. The total is 10.5. The portfolio return is 10.5%. Portfolio return is 10.5%. Part A question answered or not? Yes. What is the expected return of a portfolio of two assets invested in equal proportion is how much percent? 10.5%. Part A over. Right or not? Can I go to part B? Now let's do a part B question. Everybody. What is part B question? If a portfolio of two assets has a beta of 0.6. My target portfolio beta is what? 0.6. Has a beta of 0.6. What is the portfolio weight? To have a 0.6 portfolio beta, how much should I invest in what? A. So how much invest in what? Security. How much invest in what? Risk-free. Is the second question. Everybody, yes or no? Can I proceed above? Now, write down. Next. Part 2. Part 2. Portfolio weights. Part B. Portfolio weights to achieve a portfolio beta of 0.6. Portfolio weights to achieve a portfolio beta of 0.6. To achieve a portfolio beta of 0.6. Enappa purinjudha? Now, can I start or not? Now, beta of portfolio is equal to WS beta S. What is WS? Weight of security into beta of security plus what? WRF beta RF. WS beta S plus WRF beta RF. For all practical purposes, the second term is what? 0. Why it is 0? Beta RF is 0. Response is not. Simply beta P is equal to what? WS beta S for the risk-free and risky security combination. Right or not? Now, can I start putting the numbers or not? What is portfolio beta? 0.6 is equal to WS into 1.6. Just for understanding, I wrote here plus WRF into 0. The term is never going to vanish. 0.6 is equal to WS into 1.6. WS into 1.6. Now, what is WS here? WS is equal to 0.6 by 1.6. Weight of security is equal to 0.6 by 1.6. Is equal to how much? 0.375. 0.6 by 1.6 is equal to 0.375. I should put how much of my money in the security here? 37.5% of the money. The balance should be in what? Risk-free asset. Weight of RF is equal to 1 minus 0.375. Is that problem? Weight of the 0.6 is beta. Okay. If I invest 32.7.5% money in what? Security. The balance should be in what? Risk-free asset. Weight of RF is equal to 1 minus 0.375. 1 minus is equal to how much here? 0.625. Write down. Invest 37.5% in security. Invest 37.5% of wealth in security. Invest 37.5% of wealth in security and 62.5% of wealth in risk-free asset. Invest 37.5% of wealth in security and 62.5% of wealth in risk-free asset to have a portfolio beta of what? 0.6. To have a portfolio beta of 0.6. To have a portfolio beta of 0.6. Everybody, are you comfortable or not? Now, then go for the part C. Can you read the part C question or not? Now, two small parts pending. Part C, please. If the portfolio of two assets has an expected return of 11%, what expected return of the portfolio? 11%. What is its beta? Any question? Now, my first question is, I want an expected return how much percentage? 11%. This is called return of portfolio. Yes or no? What return of portfolio? Weighted return of the individual securities. Once I know the weights, I can find out the portfolio beta. Can I proceed? Write down. Next. We'll do it together. Part C. Portfolio beta when portfolio return is 11%. Portfolio beta when portfolio return is 11%. Portfolio beta when portfolio return is 11%. Then portfolio return is 11%. Okay. Now, what is return of the portfolio? Weighted average return of the individual securities. Right? RP is equal to return of portfolio is equal to WSRS, weight of security and return of security, plus what? WRF RF. WSRS plus WRF RF. Now tell me, what is weight of risk-free asset? 1 minus weight of security. Any accept or not? Now, are you understanding writing or not? Yes or no? Now write down. Now you tell me and then I'll put it. RP is equal to WS into what is the return of security? 16. Everybody tell me. RP is equal to WS into what? 16. Plus next term is what? 1 minus WS into 5. I am having a lot of doubt. Those understanding, raise your hand. Can I proceed? Now, then you should tell me. Okay, write down. 11 is equal to RP. I want how much? 11 is equal to weight of security into what is return of the security? 16. WS into 16 plus what is a weight of risk-free asset? 1 minus weight of security into 5. 11 is equal to WS into 16 plus 1 minus WS into 5. 6 is equal to 11 weight of security. You can simplify it. This is 16 weight of security plus 5 minus 5 weight of security becomes what? 11 weight of security is equal to 6. 6 is equal to 11 times weight of security. WS is equal to 6 by 11. WS is equal to 6 by 11. Is equal to how much? 0.5455. 0.5455. Answer me, what is this 0.5455? If I have 100 rupees, I invest how much? 44.55 in security and balance in what? Risk-free asset. WRF is equal to weight of risk-free asset. WRF is equal to 1 minus 0.5455. WRF is equal to 1 minus 0.5455 is equal to 0.4545. WRF is equal to 1 minus 0.5455 is equal to 0.4545. Respond, are you comfortable or not? Next. We should find out beta of the portfolio or not. Then what is beta of the portfolio? Weighted average beta of individual securities, right? Beta P is equal to WS beta S. Why did not write plus WR of beta R of? That is 0. So beta portfolio is equal to weight of security into beta of security. Beta P is equal to WS beta S. Is equal to WS beta S. So beta P is equal to what is weight of security? 0.5455 into 1.6. 0.5455 into 1.6. What is at here? 0.8728 times. Beta portfolio is equal to 0.8728 times. 0.8728 times. In this portfolio, if I want to earn 11% return, how much you take as risk here? 0.872 times I have to take as what? Risk for earning that particular return. If I want more return, more risk. Less return, less risk. Last part. Can I present or not? Write down part D. Part D. Same as previous, they said, if a portfolio of 2 assets has a beta of 3.2, what is the beta of the portfolio? 3.2. What are the portfolio weights? How do you interpret the weights? This is the last part, a small interpretation, good question. Okay, now, write down. Part D, portfolio weights, when portfolio beta is 3.2. Portfolio weights, when portfolio beta is 3.2. Portfolio weights, when portfolio beta is 3.2. Now, stop writing. This part D and part B question are similar. In part B, they are asking you, what is the weight for the portfolio to have how much beta? 0.6. Now, what is the weight for portfolio to have how much beta here? 3.2. The only change is the portfolio beta I am increasing, that's all. Enna write or not? Now, let's write down. Beta P is equal to, I forgot the formula. Beta P is equal to what? WS beta S plus WRF beta RF. That's say is going to beta P is equal to WS beta S plus WRF beta RF. Second part is required or not required? Not required. It becomes 0. Simply beta P is equal to WS beta S. Now, what portfolio beta? 3.2 is equal to 3.2 is equal to WS into 1.6. 3.2 is equal to WS into 1.6 plus WRF into 0. WS into 1.6 plus WRF into 0. Rearrange. Weight of security is equal to 3.2 by 1.6. 3.2 by 1.6 is equal to how much here? 2. Weight of security is equal to 2. Weight of security is equal to 2. What is weight of RF? 1 minus weight of security. Yes or no? WRF is equal to 1 minus 2 is equal to minus 1. 1 minute. Yeah, let us complete. WRF is equal to what? 1 minus 2 is equal to minus 1. For me to have a 3.2 portfolio beta, I invest 2 in security, minus 1 in what? RF. How to interpret weights? Question. How to interpret weights here? See, I have only 1 rupee. But I invest how much in security? 2 rupees. How a person having 1 rupee invest 2 rupees here? Borrow 1 rupee. Yes or no? Now, borrow 1 rupee and with your own wealth, invest how much rupees here? 2 rupees in security. Yes or no? In that case, the portfolio beta becomes more than what? Security beta because of the financial leverage. Everybody, yes or no? Now, write down. Invest 200% of wealth in the security. Interpretation is very simple. Invest 200% of the wealth in the security by borrowing 100%. Invest 200% of the wealth in the security by borrowing 100%. Invest 200% of the wealth in the security by borrowing 100%. Either we class extended capital market line, extended SML, extended. Okay, borrow and invest. But have the clarity or not? Now. Next class, we'll do levered beta, unlevered beta. Start with the sharp single index model. Okay.